SoFi Technologies currently trades at 24.91, reflecting a 6.37% dip from its recent 52-week high. While many will look at this and see a momentary pullback, a necessary breath after an astonishing run-up of over 200% in the last year, a closer look reveals a tension beneath the surface. The expectation is that SoFi is a juggernaut, a digital bank executing flawlessly. But the reality is that a significant portion of its recent gains are being fueled by a more speculative, momentum-driven narrative and a series of strategic maneuvers that are both brilliant and a little precarious. The recent CEO stock offering and the ongoing public offerings highlight a company that is capitalizing on its elevated valuation to shore up its balance sheet and fund future operations, which, while prudent, also signals that management sees this as an opportune moment to raise capital, a potential signal that they believe the current price is a strong one to sell at. This is a subtle but critical distinction. The recent news cycle has been a whirlwind of high fives and forward-looking optimism. There are reports of new ETFs, new partnerships, and new product offerings. This is the narrative that captures headlines, the relentless march of a financial disruptor. However, the underlying price action tells a more complex story. The stock recently hit a new 52-week high, only to pull back. This isn't just profit-taking. It's a battleground of competing interests. On one side, you have the momentum traders and retail investors who see every dip as a chance to buy into a stock with a powerful story. On the other, you have institutions and savvy insiders who understand the nuanced risks. Digging into the details of the recent trading days, SoFi's trading volume has been consistently elevated, a telltale sign of high interest and, more importantly, high churn. It's not just long-term holders accumulating shares. It's a constant flow of new money and older positions changing hands. This kind of volume, particularly on down days, can sometimes be a sign of distribution, where larger players are offloading their positions to a receptive retail audience. The institutional activity, while showing a net increase in holders, also reveals some interesting shifts. There's been a notable number of institutions increasing their positions, yet this is balanced by others decreasing or completely selling out. The picture isn't one of uniform, widespread conviction, but rather a mixed bag of opinions on where the stock goes from here. This divergence of institutional opinion is a powerful counter-narrative to the public perception of SoFi as an undeniable buy. The fact that the stock is trading near the high end of its 52-week range, with a P/E ratio that reflects extreme growth expectations, means any negative news, or even a slight miss on future guidance, could lead to a sharp and brutal correction. The reality is that the margin for error has shrunk to nearly zero. To understand SoFi's position, you have to look beyond the stock chart and into the company's core business model. SoFi Technologies is an integrated financial services platform, a one-stop shop for personal finance. They operate through three main segments: lending, financial services, and technology platform. The lending segment, which includes student loans, personal loans, and home loans, has historically been the bread and butter. The financial services segment is where the true disruptive potential lies, offering a wide range of products from checking and savings accounts to brokerage and credit cards, all designed to be a frictionless, digital-first experience. This is the get your money right vision that CEO Anthony Noto constantly champions. The technology platform, anchored by Galileo, provides the back-end infrastructure for other fintechs and financial institutions. This trifecta is what sets SoFi apart from traditional banks and point solution fintechs. The company's recent earnings reports have been spectacular, with record revenue and a significant acceleration of net income. This is the foundation of the bullish case, the tangible proof that the growth story is real. But past performance, as we know, is no guarantee of future results. The market is forward-looking, and it has already priced in a lot of this growth. The question is, can they sustain this momentum in a rapidly changing macroeconomic environment? Macroeconomic pressures loom large over SoFi. The rising interest rate environment, while benefiting some aspects of their lending business by increasing net interest margin, also presents a challenge to loan demand and the credit quality of their borrowers. A slowing economy could lead to a rise in delinquencies, which would hit SoFi's balance sheet and necessitate higher loan loss provisions. The student loan moratorium, a tailwind for their refinancing business, is a policy that could be subject to change, introducing a significant element of regulatory risk. The company's strategy of aggressively expanding its member and product base is brilliant for capturing market share, but it's also a costly endeavor. SoFi has been spending heavily on marketing and technology, and while this has led to incredible growth in members and products, it also means that profitability is still a delicate balancing act. They've been consistently reporting net income, a major milestone. But maintaining that profitability while continuing to invest heavily in expansion will be the ultimate test. It's the classic growth versus profitability conundrum, and SoFi is navigating it on a high-wire act in front of a live audience. Looking ahead, the future of SoFi will hinge on a few key catalysts. First, the continued expansion of their Galileo platform is critical. As more banks and fintechs adopt their technology, it creates a high-margin, sticky revenue stream that diversifies the company away from its core lending business. Second, the successful monetization of their member base is paramount. They have millions of members, but converting them into multi-product users, getting them to use SoFi for their checking account, credit card, and investments is the key to unlocking the true value of the platform. This is the land and expand strategy in action. Third, the regulatory environment is a wild card. Any new legislation or changing guidance from regulators could have a profound impact on their business, particularly their lending practices and the fees they can charge. This is a risk that is often underappreciated by retail investors who are focused solely on the growth numbers. A potential headwind is the competition from traditional banks and other fintechs, many of whom are now aggressively pursuing digital-first strategies and offering compelling products. SoFi has a first-mover advantage and a powerful brand, but they are not operating in a vacuum. The final section of this analysis brings us back to the central theme: expectation versus reality. The expectation, for many, is that SoFi is an unstoppable force of financial innovation, destined for a much higher valuation. The reality, however, is more nuanced. The company is executing its strategy with precision, achieving impressive growth and profitability, but it is doing so in a market that is pricing in perfection. The recent price action, the mixed institutional sentiment, and the subtle signals from management stock-related activities all suggest that the easy money has been made. The next leg of growth will be harder to come by, and it will be dependent on a flawless execution of their business plan, a favorable macroeconomic environment, and continued regulatory support. This is a stock for the discerning investor, one who understands the difference between a great story and a stock with a great valuation. The path forward for SoFi is not a straight line up. It's a tightrope walk with significant opportunities on one side and considerable risks on the other. It's a game of inches, not miles. Comment below with what you think will be SoFi's biggest challenge in the next 2 years. Is it a regulatory headwind, macroeconomic pressures, or something else entirely? The consensus believes in the dream, but true conviction comes from understanding the waking reality of the market. The journey from fintech darling to a mature financial institution will be a difficult one, but for those who understand the risks, the rewards could be substantial. It's a story of ambition, execution, and the eternal tension between what we hope for and what the numbers actually reveal.